This is the section of our Informed Trades Price Action video course covering price action terminology, including support and resistance. I want to explain some basic terminology for price behavior. So a trend implies two successively higher tops and bottoms in the case of an uptrend, or two successively lower tops and bottoms in case of a downtrend. The terms run up, bull run, and rally all correspond to an uptrend, whereas run down, bear run, and decline are just different ways of saying downtrend. When people say trading range, it implies that the market is moving up and down within a consistent range without establishing a definitive trend in one direction. Consolidation implies that the range of prices movement is constricting as the market becomes directionless or bears and bulls are balancing out. A reversal is a movement of the market in the opposite direction from the previous trend, and a reversal implies that that trend is over. So typically prices dip down to around the level where the trend began. Whereas in the case of a retrace, the market moves some amount in the opposite direction from the prevailing trend before the trend is eventually reinstated. Another popular concept is the two attempts rule, which is basically the idea that if the market tries to do something twice and fails both times, then the opposite will happen. So if the market is testing a new high and it tests this new high twice without breaking through after the second time, it may result in a dramatic fall in price. Alright, so support and resistance. In a trading range, or even within a trend, price action frequently seems influenced by or adherent to levels that have been previously significant turning points in the history of the market. On the price action traders' charts, these levels are marked as lines offering potential support and resistance to future price action. Lines drawn above the current price constitute resistance, while lines drawn below it are support. If one of these levels is broken by the movement of price, the function is reversed. So, for example, if price breaks through a resistance line, that line can now be understood as a support line to future price action. Support and resistance lines are typically horizontal, but when they are diagonal along a trend, they're known as trend lines. As an example of how to draw the horizontal lines, I marked some significant support and resistance levels on this chart of the Euro-US dollar pair. This lowest level at about 1.34 is established as the point where the initial trend in mid-September is arrested and turns briefly bearish. After the bullish bear tops out at this level, the two bearish bars thereafter max out as though they're experiencing resistance from the same level before there's a breakthrough on September 16th. At this point, the resistance line becomes support, and we can see that all the way 2 months later, in mid-November, this support level is tested and holds as price rises back up for the rest of the month. If you recall the two attempt rule that I explained, we can see that in action with this highest resistance level at about 1.383. We would draw this line in because it represents the height of the bullish trend extending from the beginning of the chart all the way to late October, this big trend. We can see that price returns closely to this level in the next trend peak in mid-December, and then finally tests it with the wick of this candle at the end of the month. Since the level is reached but price fails to definitively break through, we can expect a reversal based on the two attempt rule, and that's exactly what we've seen since the end of December. So the basic idea behind using support and resistance effectively in a trading range is to buy at the support level and sell at resistance in the case of an uptrend, or to sell at resistance and buy at support in a downtrend. So we're not necessarily hoping for a breakout through these established levels, because a breakout means that the market isn't behaving predictably enough to allow for safe bets on what's going to happen. So the more conservative or reliable trades are those that occur as the market fluctuates between identifiable support and resistance levels, allowing you in an uptrend to buy when there's a retracement, like a bearish leg, that's brought prices down to a support level, and then you sell when price returns to the resistance level. Or conversely, in the case of a downtrend, you sell when price is maxed out at a reliable resistance level and buy when price falls down to support. The reason we're looking to buy in an uptrend and sell in a downtrend is that price action trading is all about playing the odds, so trading with the trend rather than against it is usually a better idea, since a trend is statistically more likely to continue than to reverse. Alright, this has been the terminology segment of the price action video course. Thanks for watching. If you've got any questions or some knowledge to share, please check us out at informedtrades.com. Thanks for watching, and good luck in your trading.